Welcome, everyone, to our speaker series here. We are really excited to have this group uh, of panelists. The content today is a conversation just to uncover some of the insights and most important aspects of raising a seed round. So as our panelists give insights, I encourage the audience to think about a couple of things. One, the signals that matter here. Like, what are you saying without saying it in the eyes of investors? And what are the signals that matter most to these amazing VCs? Also, be focused on like what the sweet spots are at seed stage. Like most investors have a sweet spot where they like to invest. And so we're going to talk a lot about the sweet spot with these two. So you guys are going to be more informed going into raise as it comes up. We would love it if you would submit questions through the chat. But what we're going to do is we're going to just aggregate them all up throughout the talk. So as they come up, go ahead and just submit questions, and then we'll get those at the end. But okay, let's jump right in here. To help us through this, we have this amazing panel. First of all, introducing Jenny Fielding, who is the co-founder and managing partner of Everywhere Ventures, one of the most active pre-seed funds in the world with over 300 investments. Before that, though, she spent 7.5 years as a managing director at Techstars New York City, and apparently a little bit more time before that at Techstars as well, where her portfolio companies reached a market cap over 10 billion. This includes unicorns like Chainalysis and Alloy. She came into investing the hard way as a founder first, having built and sold a mobile company before even ever writing a check. She's also an adjunct professor at Columbia and Cornell Tech and the author of Venture Everywhere. Geez, Jenny, come on. I'm running out of breath. Simply put, she's seen more early stage fundraisers than almost anybody in the country. And so we're super excited to have her. Jenny, do you want to say anything else about Everywhere Ventures and your fund or correct what I said?
Yeah, super excited to be here. Thanks for the invite. I know that the topic is around seed. I'm actually a pre-seed investor, so hopefully the insight that I'm going to give is like how we coach our founders to get to the seed. So yeah, it might be like slightly different perspective, but hopefully that'll be useful for folks on the call.
Don't worry, that's absolutely part of the plan here. We also have Alex. Alex Iskold is the founder and managing partner of 2048 Ventures, a first check fund that leads pre-seed and seed rounds in deep tech, biotech, and platform companies. He's a four-time founder himself with exits to IBM and Tibco. Uh, and he also ran Techstars New York City before Jenny, and passed the baton, of course. But today serves as a coach and VC in residence at Harvard Business School. At 2048, he's built a reputation of being one of the fastest decision makers in early stage venture, often getting money into a founder's bank account within 10 business days. We'll see. We'll see if that holds up. Alex, you want to say anything more about your fund and or yourself?
Perfect. I mean, thanks for having me. So fun to be on the panel with Jamie. We lead pre-seed and seed rounds, so happy to give you my take and let's get to it.
Let's get to it. Okay. One of the coolest things I noticed about both of you is that you were both founders first, then you became investors. So there's this assumption that like founder investors are more empathetic to the struggle, but we almost never talk about the other side. Does having like been a founder sometimes make you less patient with founders who are making the mistakes you already made? Or like when does the empathy run out?
That's a fun question. Um, I think that Alex and I have both gone through the founder journey and have had ups and downs. And I think, as you rightly say, have a lot of empathy and think it's the most amazing thing for anyone to start a company. And we really understand how hard it is. But to your point, sometimes when we've made those mistakes, like my company, for instance, ran out of money. So one of the things that I really hone in when I meet a pre-seed founder is like, hey, can I see your model? And there's many investors out there that think that's ridiculous, right? A pre-seed founder with a model to be really just focused on product and getting it into people's hands. Like I have PTSD from that moment of not knowing, the levers in my business as well as I should have. So I think to your point, every investor has their quirks. I'm not sure if it's, being a founder, not being a founder, but, you have to get to know people and kind of understand what their triggers are. And for me, really understanding numbers and financials actually is one of the things I think is quite important at the pre-seed. And that might not align with every founder out there. But I can say that if you're raising money, you want to be really buttoned up about those things. So you don't want to get caught at a pitch or, with an investor going deep and go like, yeah, actually, we didn't build a model, or I don't know the levers in my business. So, I would say it's an important thing.
Yeah, so it's like have it, but keep it in your back pocket.
I mean, I think like, putting it out there is a great thing, like understanding unit economics. That seems good to me. But, my real point to your question is that I'm not sure it's about like what your background is, founder or not founder, but it is really about what the things that you as the investor care about. And when you're taking money for someone, you need to align with their values and what, the way that they see the world. Otherwise, you're going to always be at odds, right? And so I think you need to know yourself and really get to know the people that are going to be on your cap table for that reason.
I love that. Alex, do you have a take?
I would say for sure. I mean, for us, like I would say we're infinitely patient investor with kind of very much empathy first for the founder journey. I think candidly, the only way for me to lose empathy is for founder to be fraudulent. And I'm not kidding, like otherwise we're going to continue to support them. But if founders commit fraud or if they clearly lie, it's very difficult to have empathy in that case. But otherwise, I mean, look, these are very long journeys, pre-seed, seed. I think our goal is to be the least annoying and most helpful investor and to earn founders' trust because ultimately, in the end of the day, if somebody doesn't trust you, you cannot have impact. And it's difficult to build trust. But once you do, you can kind of tweak the trajectory a little bit. And that's what our style is.
That makes a lot of sense. I think the trust topic is going to come up a lot. I think when founders are more authentic, you get like actual trust and progress with investors. I'm curious what you guys think. Obviously founders are trying to present themselves in the best way possible. Like, where does one draw the line around like how to make sure they're putting their best foot forward? Versus, I guess, not being authentic. And is there, I guess, more importantly, how do you guys see that when you're actually interfacing with founders about like in the pitch phase, for example? Like, do you notice right away?
Yeah, I mean, I think we much rather have a founder say, like, I actually don't know the answer to that, or I've thought about it, but I haven't come to a conclusion, than to kind of bullshit us or make something up. So that I think goes back to the authenticity. Being authentic doesn't mean being right. It just means, being your true self. And so I think, again, you have to be buttoned up. You have to know your business, your product, all of these things, your customer. But if you've done your work, it's totally fine to say, like, oh, that's an interesting question. I hadn't thought about that, or let me get back to you with some information, and I feel good about that. But when founders kind of fumble on that, on questions, because they haven't thought about it, but they try to finesse it, I think that it doesn't usually come off too well. So I'd say stay away from that.
Could not agree more. Yeah, I mean, look, the reality is Jenny and I have seen so many movies over the last decade that literally within first 15 seconds, you know whether somebody is not truly into this, is not truly the right fit for this specific business. I'd say where I have personally potentially a bit more difficulties, I feel like people's styles are shifting because we're experiencing sort of generational changes of like who is becoming a founder. And I find like sometimes some of the younger founders are just like really casual for my taste, and I just can't really parse whether this type of casual behavior can then anyway yield, like can somebody who behaves so casually, build a huge business? Like, for example, increasingly founders and some of their customers, they text each other. That just seems unfathomable, like even 5 years ago. But this is the new culture, right? So the thing that we should always be mindful of as investors that we're not the arbiters of what the world needs. We're basically the arbiters of people who we feel are going to build the next gen of the world. And so that's actually a very interesting and challenging thing that we have to deal with these days.
Oh, yeah. That I that makes perfect sense. Okay. So I have another founder-based question for you guys. What's the single thing you wished someone had told you as a founder that you now know as an investor?
I
Alex,
mean,
you want to?
yeah, like I feel candidly that I wasn't even like in the zip code of the caliber of the founders that I'm investing right now, but I feel like the number one thing is building team and building culture is probably ultimately the hardest thing because in early stage where Jenny and I invest, you basically have couple people, they're superhumans, they can get early customers, they can get the ball rolling. But the difficult part is really scaling because to get to venture scale outcome, so much of energy goes into then building culture, inspiring, especially the world has become so mercenary. People float in and out in 20 seconds. AI makes everything worse from that perspective because people are constantly FOMOing. And so I think the number one thing that I wish I knew better, and I still am learning like how to do well, is like building exceptional teams and building exceptional culture.
Yeah, I was definitely going to say build a team. Very transparently, my first company, I had come from a very different background in finance where you were always supposed to kind of like be right and find the answer. And so I took a lot of that into my first startup. And the problem was like, as we grew and as we had 70, 80 people, it's like you can't be in control of everything. And I wish someone had said, like, it's actually okay. It's okay to have partners that you trust who are executing, and that's actually a good thing. And so now we really over-index for teams, whether you're, a solo founder or not, but that you have a foundational team that you really trust more, than anything, and that they're high caliber and that they're smarter than you as the CEO. I think there was a lot of insecurity for me as a founder that I didn't see play out, in the way that I would have liked. And now I've seen that over, a decade with founding teams and the ones that just have this incredible trust and the co-founders that just, actually think each other are the smartest, most amazing people have something special. So I definitely say like over index on that.
That makes a lot of sense. And I think as a founder, sometimes you feel like you have to wear a superhero cape, right? But like really what I'm hearing you guys say is like it's about surrounding yourself with the people who are going to support and like actually be superheroes themselves too. It makes perfect sense.
And it's actually like
Alex,
a magic moment where you feel like you don't have to do everything, right? Because you have such inherent trust from these foundational people on your team that like stuff is just happening and you're not even part of it. That's like when you have that, it's in kind of a magic moment in your startup where you realize that, not everything is about you. So yeah.
I mean, I just think that's spot on. Alex, you said like in the first part of your answer about like how basically you feel like you're investing in founders who are just like way higher caliber than you were. And like as investors, it seems like you guys, a big part of it is that you are evaluating trends in real time as they're happening. Uh, so right now, the like median seed valuation, which has changed even since I raised, right, by a lot, is now a 20 million post. The 95th percentile for a seed round is up to $80 million as a valuation. Um, so okay, so Alex, when a founder comes to you and names a number, like what's your reaction and like and what does their like actual valuation ask like tell you about them? And then Jenny, as a follow-on, um, does the valuation like a lead sets for a round when you're making a decision affect your decision? I'll let Alex answer first.
Yeah, I mean, look, I mean, I feel like the way that it actually works is thankfully we're still in a market economy. And so founder doesn't tell me exactly the valuation, and I don't tell them exactly the valuation. It's a negotiation, but every single deal is competitive. And one of our superpowers is moving very quickly without skipping steps and being very respectful. But the point is like, I'm not really spending much time in the beginning thinking about the valuation. It sort of will figure itself out, and I will probably not underwrite $80 million post seeds as a rule. We do make exceptions. So we have made an exception recently where we participated in the seed that was $60 million post. Now that's one time. Maybe we'll do it twice during the fund. Now, but the reality is that also the data you're giving is probably skewed. That's probably not the average. I think that the world is really split right now between I would say actually on average, pre-seed maybe even has gone down, and I've seen a lot of founders struggling to raise earlier rounds, and as a result, the valuation is going down. And then obviously we're on the other hand, we've read about like a seed that's at a $5 billion post. If you factor that in, yes, I can see how numbers get skewed, but that's these are like far in between. That's not where we are. But I think, look. I feel like 20 mil post for a strong seed is a very fair price. We can talk about it, I'm sure we will, like what it takes to get to that valuation. But I'll pass it over to Jenny to get her take.
Yeah, I mean, I'll pick up from there, which is to say, first of all, every vertical is slightly different. So, something, a valuation or a milestone or, metric you need to hit with, say, hard tech might be different than vertical SaaS, which might be different than something else. So, kind of keep that in mind. But Alex and I spend a lot of our time with vertical SaaS, or vertical AI, so we can kind of stick with that for the moment. I'd say the first thing is that I have a lot of empathy for founders right now because the goalposts keep on moving and shifting. And so one of the things that you said, Adam, was like, oh, when I raised, it was actually different. And that wasn't that long ago. So as a founder, you do have to kind of understand what the benchmarks are. I'd say in, a typical vertical AI company going out for a strong $5 million seed that's already raised a pre-seed, the expectation is that there's actually going to be some really nice momentum in that business. And I would say, several hundred of ARR, right? And so that's quite different than, maybe the seeds of long ago. So the first thing is just level set on what we're talking about. For pre-seed, for the most part, we're talking about rounds. I mean, let's take out the crazy California rounds, but we're talking about rounds that are maybe 2 million in size. These are really, just getting off the ground companies. We don't expect there to be any like revenue metrics, but we do like to see momentum in the business. And so that can be early customer discussions, pilots, that can be a product that's built, something. And that's what we look for. It might be different than what other investors look for. So the first thing you need to do is figure out who you're talking to. So that's for a pre-seed. So say you raise that 2 million. Well, the next investor at the seed is going to say, okay, so what do you do with that 2 million? And if you've just like been building product and kind of, tinkering around, it's much harder to get that next round done. Again, let's call it in a vertical AI situation. So they might expect that you have 500K ARR, that you're approaching a million, you're increasing every month at a certain rate, right? So these are the things that are changing all the time, and you really just need to kind of stay abreast of how big the rounds are and what the expectations are. So that's like
Mhm.
my just advice. And that's really changed because
Yeah.
during the kind of boom days of 2021, like you get a $5 million round done with, 50K of ARR. I think those days are gone for now.
Yeah.
Yeah.
And I will also add to this, there's like so much nuance and like definitely not one size fits all. So first of all, like there is really no pre-seed in bio and deep tech because those companies need more capital. So those pre-seeds really look like seeds. But what I've been thinking about ahead of this conversation is that I actually am going back to earlier days where I feel like I'm a big fan of much smaller pre-seed rounds, like not even 2 mil, but maybe anything between, and I know it sounds crazy, but like 500K to 1.5 mil. And I can explain why, because then you can actually show up and say, hey, I want to raise like 3 to 4 to 5 mil seed, and you can show things. And the goal of pre-seed really always has been, it has been an instrument for like a 9 month sprint, which I know sounds insane, but that's what the pre-seed was meant to be originally. It's like small
Mhm.
amount of capital, just the founders, and go prove that hey, you can actually you can make a little bit of noise, and then you go and you convince seed investors to take a bet on you. Because I'm sure we'll get to it, but like in a way, half of the seeds are still leap of faith bet on the founder, and then half of the seeds are scrutinizing numbers and like going into financial model and everything. So what what I'm observing is that we just invested in the team and they said the magic words. Like they wanted to raise 1.5, we wrote $1.2 million check, and they're like, we're great, we're getting to work, we're not in the hurry to get the rest of it. And those are the magic words, because in the 12 years that I've been in venture, if I look back, the best outcomes are scrappy founders, like founders who are not hungry for cash, but hungry for customer money, and who are just willing to, on a shoestring budget, do magic.
I
I
love
would
that.
just really agree with that and also say that, runway is something you really need to think about in this market, right? Because as Alex mentioned, there's the haves and the have-nots. And the haves are able to raise maybe every 9 months or even before that. People are trying to preempt their rounds. They have, really intense metrics, I'd say, for most of those, like stellar teams, like there's certain characteristics. The have-nots doesn't mean they're not amazing companies. They're just taking, longer to get going. And we have tons of those in our portfolio that we think are amazing companies, but we can tell them all the time, like you need to make sure that you're going to have enough money because you cannot expect that next round is going to happen. And so what is your kind of plan B? It's super important. You cannot get to 6 months of revenue, 6 months of runway and then expect the seed to happen because it may not. And again, it may be a really good company. It may not just be in the buzziest category, or maybe they're moving more slowly, or they had to pivot. And so you have to manage it super, super carefully, your runway. And so, yeah, that can mean a few different things. It could mean, taking a little bit more at the beginning. It could mean being scrappier. There's lots of ways to play it, but we just see companies starting, their runway is dwindling. They're down to about 6 months and they kind of just expect, okay, well, September's a good time to raise. Like, we're going to go out and raise in September. I'm like, I mean, you just don't know what's going to happen.
Yeah.
Yeah, I would also say there's two kind of forks here in this conversation, but one of the things, since many founders are listening, I feel like so many people are under massive pressure because we're observing, like, every day on TechCrunch, like this raised like 500 million, another thing raised a billion, this is a cajillion, this is a billion, and it just makes you feel like you need to be that. Now, if you're watching and if you're paying close attention, there's now a new narrative where a lot of these companies that raised a ton of money are now they're starting to say, well, oh, by the way, we have a lot of churn and AI naturally has a lot more churn than other businesses. Listen, nothing is free in the universe. Not yet, and I don't know when it will be. We exist in friction. And so no free lunch. Sure, these things have massive takeoff, but it takes really long time to build great products, to build great businesses, to build solid foundations. And so, what Jenny was saying is some of these companies that are pivoting, refining, working, they will still be the winners ultimately. They will, and I know today like SaaS is down, everything is in flux, but you need to take a perspective, and perspective is simple. Everything that's great takes time. And this narrative that overnight hundreds and hundreds of millions of value is created is a false narrative and certainly isn't ubiquitous narrative. So that's something that I feel like needs to be said more often. And good things take time.
I mean, I
I
would add though that sometimes I feel that founders are pitching me an antiquated playbook, right? Which is I want to come out and raise $3 million because I need to hire 12 engineers. And I'm like, okay, you're going to burn through that 3 million and there's going to be a one person team at YC coming pretty fast and furious behind you who's raised no money and is able to get to your metrics. So you have to be careful of that as well. Make sure you're playing, the game on the field as opposed to kind of the old paradigm of like, okay, I raised my 3 million, I'm going to hire my 10-person team. Got to be careful on that
Mhm.
because things are really changing, especially with AI.
This has been that is so insightful, by the way. And it brings up you kind of brought up like an old way of doing things, and now like the world has changed a bit. Again, you guys are like trend watchers. You understand all these things. An old trend was like if I'm gonna raise a Series A, I need to get to the 1 mil ARR benchmark, right? I think that number is now low for what people are expecting. But I'm curious, like Jenny, like as a founder, completes their pre-seed round, like are there certain milestones that you're hoping that you're like prepping them to hit for their seed round? And kind of like what are you telling founders around that?
Yeah, I mean, I think more than an absolute number is really the growth rate. So if you can show a steady growth rate month over month that you're consistently converting, and obviously if you're doing enterprise, consistent conversion is super hard, right? But really packing your funnel, understanding like how you can massage, your funnel to make sure that things are converting in an up and the right into the right way is really important in this market. Because again, they're not just expecting 500 to a million ARR, but they're expecting to do that in a much more compressed time period. So I think that you got to look at, I can't really give you an exact number. You need to be growing 30%, but you have to kind of look at, the comparables in your markets and what other folks are doing. Cause that's I mean, ultimately you're going to be seeing the same VCs that your competitors are, right? Or adjacent companies are. So you kind of have to know what their growth rates are.
That makes sense. That makes a lot of sense. Alex, what do you think? Can I ask you the same question about seed companies who are targeting a Series A?
Yeah, I mean, Series A's are hard. Series A's are hard for sure. I mean, I think that everything Jamie said applies. Bar is so much higher. So just to recap for seed, I think if I wanted to generalize, which is always a bad idea, but let's say we take a general vertical AI company,
Mhm.
significant growth, maybe not months over months, but quarter over quarter, you need to be north of 50K MRR, ideally maybe higher. If you're in the 30, people will look at it, but like anything below would be harder. And then I think, most importantly, you need to be always intelligently speaking about unlocks. That's what people are looking for. Like, what have you learned? What have you unlocked? What is your unique insight in order for people to take a bet? Now, for Series A, it's a completely different ball game. I mean, people literally, I think we just had a company that got a term sheet for Series A, and they were 2 mil ARR, and that was close. But that's it's a very fast growing company. It's in AI in fintech, and team is off the charts. MIT, Harvard, they're based in the Valley. They did YC, so it's like a force of nature team with 2 mil, and they had to work to get that Series A, and it's a great Series A. The other Series A that we just had recently was highly experienced, highly pedigreed founder. They had less revenue overall, but it was an investor who knew them. So I wouldn't kind of bank on that. But if otherwise, you need to be north of 3 mil of ARR. I candidly feel like if you're at that level, you should have a lot of insights on your go-to-market motion. Like lumpy revenue is not going to be underwritten. Like not lumpy, but like heterogeneous revenue, like no clear unlocks. It's like all over customer base. Like this is not going to go well with Series A investors who are very cautious. And I think Series B is the truly new Death Valley where people that just don't want to be underwriting anything that's not AI and not growing. Absolutely insane. I mean, I feel like Series B's are truly, truly hard now.
Yeah, I'll just say the Series A is tough, and we have seen a number of kind of extensions on seed rounds to hit those metrics. I think if you want to get a Series A done easily, it's 3 million. If you want to get it done, it's 2 million. And if you want to sneak by, it's like, between 1 and 2. So that's kind of what we're seeing. We had 4 Series A's happen in Q4, which actually had taken a while. These companies had been seed stage for quite a while. And they were all above 2 million, which was kind of shocking to me. I mean, that's a pretty high number. So that's where the bar I think is today.
Is the major influence here on it being so competitive for Series A the fact that there are just a lot more pre-seed and seed funds that have been created over the last, 5 years, but there haven't been as many like Series A funds to match it?
No, I mean, I think, well, first of all, there's been massive attrition in emerging managers. So all these funds you're talking about, a lot
Yeah.
of them are gone. So there's actually a lot less capital now, but the companies that were funded 3 years ago by those managers are still around. But I think, no, like, I mean, the design is correct. I think just dollars are pointing in a very concentrated direction. So effectively, Series A funds have now, because of the pressure on them, that's basically kind of like an echo chamber, but the pressure is unless this is a AI rocket ship, I should not be investing in it, which is what, or it's a deep tech or some sort of unique biotech. People are not investing in just sort of basic bread and butter businesses as much, and that's because they feel like alpha is elsewhere. And so this is like an adjustment of where the dollars are going, not necessarily a function of how many, pre-seed and seed companies. But I feel like Series A is like first, once you close Series A, those are the first 10 seconds where you maybe have a right to exist. Like effectively pre-seed, seed, these are just like basically still very much experiments.
And
Yeah.
I would add that the amount that founders are raising has also shifted. So in the four Series A's that I mentioned that happened in Q4, they were all over 10 million. So, those are pretty large rounds.
Yeah.
And then the Series
Correct.
B's are massive. We have a Series B coming together. I think the founder told me 35 million. So these are fintech company. Wow. I mean, these are like pretty large amounts of money. So, in a way, everything got shifted up one or two notches of where they used to be, and what we used to call them.
That's really interesting. Well, so I also, yeah, I can't let go of the opportunity here, in that I have, an investor who likes to lead rounds and one that definitely primarily follows. So I think we should talk about that dynamic a little bit and your guys' viewpoints. So kicking it off here with Alex, like when you lead around and just to like make sure that everybody's like in alignment here, like what are you actually committing to that like a follow-on investor is not?
Well, to be clear, I think Jenny commits before I commit, so I don't know if she's a follower. Jenny is not a follower, right? So let's just set the record straight. But look, I think that the dynamic is very symbiotic between us. We're in a bunch of deals together, but I think the work that we do as a lead investor, effectively, we are set up with our team to do a lot of due diligence work. And then ultimately, we often are the ones who negotiate with the founders around like what cap the investment is going to be. But the reality is we're just writing a slightly larger check compared to other people. And
Mhm.
so that's effectively is making us a lead. Now, we then take typically at the pre-seed we take board observer, we don't take a board seat, and then at the seed we would take a board seat. And effectively this is a very important topic which sort of like comes after you've been in venture for some time, but like governance is always important. Being there with the founders, for the founders, even since day one, like that's a very important part of kind of what we do and how we stay involved.
I would say on the lead and follow, appreciate your sentiment, Alex. There's two types, I'd say, of followers. One is they are looking for the diligence, the governance, the name, all those things that Alex just mentioned that he could provide as a lead. So, oh, Alex is coming in, I'm going to come in. Then there's folks that write small checks. So that's us. So we're now typically writing a 250K check. And we're conviction driven, which means we will commit first and be, your first believers. We just need to help you get the round together. So I can't just put a 250K check into a round that needs to be 1.2 million. And so, it's about, having that community of other folks that can fill in the round. Sometimes it's a lead, so we will pass something over to someone that ends up being the lead, and we're happy to slot in. But oftentimes it's just a group of other emerging managers that kind of fill the cap table. So I think it's an important point for founders to understand. Find investors that have conviction in you and your business, as opposed to your kind of fill in, because ultimately, they're the ones that are going to help you unlock access to other capital, to other investors, and really the ones that are going to support you because they have conviction in your business, not just in whoever is coming on the cap table. So again, we write a small check. So oftentimes we slot into other rounds, or, we don't set the price, but we, make introductions to a syndicate of other investors who can fill in the appropriate amount.
That's really interesting. And this is not a question on my list here, but it's pretty clear that it, well, let me ask actually, how many deals have you guys done together?
I'd
I think
say probably like five. Yeah.
4 or 5. Yeah.
And it's probably not that uncommon that investors buddy up, right? Like when it comes to co-investing with each other. I would imagine that you are not a unique pair, right?
Well,
Um,
let me give you an
It's
insight.
actually uncommon, but yeah, go
oh,
for it,
okay.
Jenny.
Well, let me give you an insight. When you're kind of one of the smaller checks on the cap table, sometimes the smallest check, you actually are in a somewhat vulnerable position, right? Because we're not taking board seats. Oftentimes we do have information rights and other types of rights, but our insights into the company are really just based on the relationships that we have with the founders. So I learned the hard way, just to be transparent, that when you're stuck on a cap table with people that you don't align with, um, you know, in many ways, sometimes you can end up, getting screwed. So one of the things that I have adjusted over my 10 years of investing is really making sure it's not just about me and my conviction getting into this company. Like that's just one part of the battle. The other part is making sure that there's other folks on the cap table that we're mission aligned with, that see the world in a similar way, and that want to, help build the company in a certain way. And that, again, I've had bad experiences with that, and I've had great experiences. So it really behooves us to be, with the right group. Obviously, it's a joy to invest with Alex. We're also close friends. We've worked together for many years, but we're on the cap table with many people, and we do spend more time now. I'd say that was a learning to just really understand who those people are and what motivates them. And I do think that's important. And that's something most founders don't actually understand. So sometimes when I say, who else is around the table, it's not because it's a signal of like, oh, I want to invest because she's on the cap table. It's like, well, I got to make sure that, this is a syndicate that I can really mesh with.
Wait, before Alex jumps in here, I just gotta know. Um, have you ever been really interested in a deal and then seen who else is coming in and that's turned you away completely?
I have a few investors that I will not invest in because I personally have had negative experiences. I wouldn't say it happens, very
Mhm.
often. I mean, for the most part, it's a very collaborative industry and we've had good experiences, but there are some people that I just won't invest with. And I'll be very upfront with the founders, like, make your own
Yeah.
decision, of course, but that's not an investor that I want to be on the cap table with.
Interesting. Well, quick shout out to my own company. If you want to figure out which deals these two co-invested on, Metal can absolutely tell you that. So, okay, I'm going to transition here. Why don't we call this kind of like the lightning round because I neglected our audience questions a little bit. So why don't we just kind of like hammer through a few of them? Uh, because we got some great ones. I'm just going to dive in here. All right, so. As first check investors, do you prefer founders to bootstrap their initial PMF and CAC testing? Or is that exactly what your pre-seed checks are meant to underwrite?
Alex, why don't you take this?
I mean, I don't want to hear the word CAC in pre-seed and seed. This is nonsense. This word needs to be erased. CAC and LTV do not belong so early. Like you just don't know. But I feel like, I love the first word that you said, which is bootstrap. I love scrappy founders. Like there's clear distinction between the founders. Like, hey, you know, pay me to build this versus I'm just so convicted that I need to build it. I can't sleep. I can't think of anything else. I'm already well in motion. And do you want to
Mhm.
hop on my train? Those are the ones that I want to invest in.
100%. Exactly what Alex said.
I love it. Well, so then, like, how do you guys think of a bootstrapped company with a strong team, paying customers, and good retention, but slower growth due to limited go-to-market spend? Or does
I
that
mean,
just sound like an excuse to you?
no, I mean, this seems to be the new paradigm, right? Folks are saying, they want to put Alex and I out of business because they want to bootstrap. And like, I think it's great. I think you just have to understand as a founder the way you're going to be judged, right? And so, do you understand that? If I was a founder, it's probably the path that I would take. I bootstrapped my first company and raised some money from some angels. It is a slower path, and I think it's a great path, but do know that if you change your mind and you decide you want to go high velocity, folks will say, well, you've been around for 3.5 years. Well, what were you doing? So you just have to know the game that you're playing and don't be surprised. I think either path is great, but just understand the consequences of both. And obviously, the
Mhm.
consequences of taking venture are pretty significant, right? Once you're on that hamster wheel, you're kind of on it. You can't then be like, oh, actually, I want to bootstrap. So you just got to know the game that you're playing.
I love it. Okay, I have another question here. I'm going to adjust it though. So the original question was, what milestones do you look for at a pre-seed or seed for deep tech startups? I'm going to adjust the question to what milestones do you look for companies that shouldn't have revenue yet at your stage?
Yeah, I mean, basically, I look for fluency. In deep tech, I want to know bill of materials. I want to know full supply chain. I want to see exceptionally intelligent financial model because effectively, okay, I'm going to build massive rockets and compete with Musk, but I couldn't bother to build a financial model is a non-starter for me.
What he said.
I love that. I like a good ditto. Okay. What valuation in caps are you seeing for vertical AI at pre-seed? And where does the line between angel and institutional pre-seed typically sit?
That is a great question. And there's so much nuance here depending on founder background, right? So, to AI researchers that spun out of Google that were working on something for 10 years, who are based in San Francisco versus someone that's starting a company in Atlanta in that space. So, your geography and your background are going to factor into that. But Alex
Mhm.
did mention something earlier, which was interesting, is that we actually are seeing a softening in the pre-seed. Now, there's always going to be the buzzy rounds that, are raising at crazy prices. YC is also setting, a bar at a price. So if we take those two out and we say, a good team, coming out of a reputable either, university or company, we are seeing the pre-seeds like, under 12 million now, and that can be anywhere from, 6 to 12. So that's traditionally what we're seeing. Around like that would be anywhere from, a million to two. And it would be enough runway, I would say, for 18 to 24 months.
Alex, what do you think? Any opinions? Or is this another ditto?
I think you said lightning round, so I'm not allowed to
Oh,
have a second
okay,
opinion.
okay. Well, so I have a great. This will kind of be our final question here because we're a minute over time. Sorry, guys. But you mentioned smaller pre-seed rounds, Alex, earlier in this conversation, down to like 500K. So this question I think comes on the heels of that. So for the smaller pre-seed rounds, what's the minimum equity you'd look for? And do you prefer safes at that stage?
Yeah, I mean, like I can't understand anything but safe. So basically, I think convertible notes are just archaic and evil and only useful in bridge rounds. And then equity is absurd at such an early stage because it's very expensive these days and takes a long time. I think, look, in terms of equity, I think it's always a negotiation, but
Mhm.
probably it's difficult for the founders to raise any capital and not give like 10 points. So that's the downside of, I mean, I think it's very hard to raise like 500K for 5%. That's probably unusual. That said, there are caveats where, that type of deal maybe you can do if it's like you're at MIT or Harvard and, you're graduating, whether from business school or from proper school, and you have VCs or angels are throwing money at you, well, you're most likely going to raise an uncapped, so it won't even be capped. So realistically, I would say that no matter what round you race, you're going to give up anywhere between 10 to 25 points. Now, obviously, if you are giving up 25% for 500K, you're on Shark Tank. You're not actually in venture. So don't do that. And then there's everything in between.
I'll just say I don't love the 500K round. Again, unless this is like something, spinning out of a research lab or something going into like a program, right? So if it's in some type of programmatic style, I have been, kind of getting away from those very small rounds, and a million will give you enough runway. So it's kind of hard to break out like where the 500. And sometimes I get cold emails from people, and they're like, "I'm only raising 200K." It's like, okay, is that actually going to be enough? So you have to kind of think about that as well as like, are you going to be able to attract an amazing team and get you 18 months? And I understand there's some people that like to break it up. So I think if there's some program that you're going into and that's the number, or there's something specific that you're doing, you're like an amazing researcher coming out of like MIT and you're kind of a solo person trying to figure something out. That, yeah, otherwise I'd say raise a little more.
Um, okay, guys. I should have clearly made this an hour and a half. But I feel like I could talk to you all day. Thank you so much for joining us. This was amazing. Jenny and Alex, I hope we can have you back at some point. Because again, I think that we didn't cover nearly as much as I wanted to, but there was so much great insight, and I really appreciate you guys. Thank you, thank you, thank you. Um,
Well,
and
thanks so much for having us.
Yeah, thank you.
Alex and I have spent the last decade like trying to just get the word out to founders. We were founders, and I don't feel like we had all the information that we wanted, and we live in a really different age. But I'd say there's a lot of noise out there too. So just make sure that, whoever you're listening to are credible, and I'd keep that in mind too.
And I was gonna ask, like, if you guys, if you have final remarks, it sounds like that was touching on it, Jenny. But like, yeah, is there anything else that you're just like, hey, this came up, maybe throughout the conversation or something that or you just think founders need to know and they're not hearing right now?
100%. I will tell you that if you're a founder and you believe that you need to build it, go do it.
It's pretty good. Jenny, do you have anything?
I'm gonna end with that. I think that's
Rock on.
it.
Okay. Again, thank you so much to our panelists. And thank you everybody who came and attended. We had a great audience here. Um, Over and out. Thanks again.
Bye, everyone.